Good morning. Hope everyone is doing well. My name is Tom Lyon, and I'm the practice group leader for the M&A practice at Manning Fulton. Welcome to this week's webinar. We're going to talk about M&A trends this year, and we're doing it in a panel format. So I'll serve as moderator, and I'm going to ask questions. We've got a great panel. We've got 3 different representatives from private equity groups. Starting off, we've got Sydney Farrow from Blue Run Capital. We've got Doug Vaughn from Sharpview Capital, and we've got Alice Birnbaum from Brown Brothers Capital. And what we'll do is I'll ask a series of questions, and for you guys in the audience, please type some questions in the chat room. We hope that at the end we'll have time to answer your all's questions. So I'll start. So with you, Sydney, introductory question, please describe your background and your fund's acquisition or investment focus, whether it's a geographic or industry focus, kind of typical transaction sizes, and investment time horizon.
Sure, thanks, Tom, and good morning, everyone. So yeah, my name is Sarah, based in Durham. So Blue Run was formed about a year ago. We are a fundless sponsor focused on the lower middle market here in the Southeast. We'll typically look for businesses up to 5 million earnings, but I'd say the sweet spot's really between 1 and 3. Typically, those companies are family or founder-owned, and we're sort of the first institutional capital where there's not necessarily a natural succession plan. I'd say broadly speaking, we look for businesses where we can add value sort of day one, so a lot of industries won't look at. We always joke the sexier the better, the unsexier the better for us. And again, really looking for businesses located here in the Southeast. Thanks.
Doug and Alice?
Yes, good morning, everyone. My name's Doug Vaughn. I'm with Sharpview Capital, which is an alternatives platform. We have 2 strategies, one being Southeast-focused real estate. The part that I'm involved with is a credit and equity strategy for the lower middle market. We typically focus on providing debt and equity to lower middle market businesses, which we define as sort of 2 to 20 of EBITDA, or if you want to think in terms of revenue, probably 10 to 100 million of revenue. We do have a nationwide footprint, so and we support private equity, sort of institutional capital, private equity sponsors, as well as directly with companies for growth and so forth. Check size ranges from $3 to $20 million, and again, industry agnostic, so we'll look at all industries.
Hi, everyone. Tom, thanks for including me this morning. My name is Alice Birnbaum. I'm the head of business development for BBH Capital Partners, which is the private equity business within Brown Brothers Harriman. We've been in private equity for 30 years. We've raised over $4 billion in capital. And today we're investing out of a couple funds, writing equity checks of really anywhere from $10 million on up to $130 million or north of that with co-investment. Our floor in terms of company size that we might invest in is usually around $10 million in recurring revenue and $3 million in EBITDA, but we don't really have a ceiling. And the reason for that is because we're pretty flexible in how we invest. In addition to being flexible with how much we invest dollar-wise, we're flexible in terms of whether we are a control or non-control partner to the companies that we're investing in. So we could own anywhere from 20% on up to 90% or more of any given business, and we do in our portfolio today. I think that flexibility allows us to focus less on, the investment, the dollar amount, how it's structured, and we can focus more on really finding the best management teams and the best companies across industries, and being a good partner to them. And usually what we're doing is we're providing some combination of liquidity, maybe to clean up the shareholder base, or liquidity to the the founder who might want to take some chips off the table. We're providing growth on the balance sheet to execute a pretty aggressive growth strategy. We aren't really the private equity fund that comes in and buys out the founder and puts in our own CEO and then runs in our own direction. We really like to be more of a partner to good management teams, good founder operators who have a growth plan, they have a vision, but they just need a partner to help get them there. So those are really the situations that we're a good partner for.
Thank you, Alice. I think the three of y'all would say that this has been an interesting year to be in the M&A world. PitchBook last week just came out with their third quarter M&A kind of analysis. And what they showed was that the number of deals in the third quarter picked up significantly, that there was a rebound. They went up 24% in North America. And kind of two facts that I thought were interesting from the PitchBook study was of Q3 private equity deals, 73% were add-on, which is pretty, I think, probably as high as it's been. And then year to date, 67% of all M&A deals in America are under $100 million. So this lower end of the middle market is where a lot of the focus is. All right, so the second question, what has it been like to be in the M&A world during 2020? It's an election year, we've got political unrest, we've got COVID. Alice, what have you seen?
Yeah, well, going back the start of this year, I mean, the M&A market was booming, the economy was healthy. As we all saw, the music stopped in March and April. Pretty much nothing got done during that period unless it was pretty far along coming into COVID. Starting around, so, you know, March and April, the credit markets were also kind of effectively closed, so it was hard to get any deal done in those months. And then, you know, May through summer, things have started to creep back. And then since Labor Day, we've seen a noticeable uptick in new deals coming to market. And when I say new deals, we're focused more on like the founder-owned, lower middle market businesses. So that's kind of where my comments are around. So since Labor Day, we saw a 60% increase in new deals compared to the prior Memorial Day to Labor Day period. So we've seen quite an uptick in activity and new deals coming to market. So why is that? I think it's a few things. Number one, there's pent-up supply from businesses that would have liked to launch or pursue a transaction in the first half of this year, but the curtain fell and they either launched and had to hit pause or they didn't launch at all. So now there's kind of a sentiment of this is their window of opportunity. Let's get something done when we can. So there's a pent-up supply from the first half of this year getting pulled into the second half right now. The other thing that we've seen is anytime there's an election year, there's going to be some number of business owners who, you know, they're expecting a particular outcome. They want to get something done in the fourth quarter, and there's kind of a crush of time to get that transaction done before year end. So we're seeing that too. The other thing too is I think this has been a tough year on business owners, on everyone. And there's some number of business owners who would like to take on a partner. They'd like to take some chips off the table. They'd like to de-risk a little bit. They'd like a partner who can help them from an operational standpoint, a strategic standpoint. So, you know, maybe where they wouldn't have done anything this year based on their experience, they're now saying, you know what, I was thinking of maybe taking some chips off the table next year or further out, but I'd like to do that now just in case things get really tough again. So we're seeing that as well. So some number of, you know, deals that are getting pulled from the first half of this year into this period, deals that would have happened in the future are getting pulled in the second half. So that confluence is creating a lot of activity. The other thing I'd mention just is valuations. Obviously, if we were seeing like a COVID discount being applied across the board to businesses that were coming to market, folks would be less interested in pursuing a sale or some kind of transaction. But what we've seen is, if a business has been resilient and performed either sort of neutral to positive this year, the market is reacting very favorably to that story. There's been no sort of COVID discount to businesses that have performed well this year. In fact, quite the opposite. So valuations, if we thought that COVID might break the logjam on valuations, we certainly haven't seen that. So, valuations remaining high and having investors like ourselves sitting at home with time and money on our hands, all that. I think we all got sick of the phrase dry powder earlier this year. All this dry powder in the market. Well, that hasn't gone anywhere. It still needs to be invested. So the confluence of all of these things, I think, has just created a ton of activity with deals coming to market right now.
Alice, thank you. And for Doug and Sydney, you're all seeing about the same? That did get into kind of our next question about valuation. Consistent with what you guys have seen?
Yeah, I think Alice hit it well, at least from our perspective on the deal volume. Really, for the last few years, there's been just this appetite, lots of money being raised, just a lot of activity on the M&A side, to the point where, and she alluded, it's kind of an answer to the valuation question too. Things were very frothy, really without much discernment across industries. And I do think, as Alice mentioned, the COVID impact was a couple-fold, really. The market, backed up for all of about 2 weeks. Now it did freeze for a little while, but what we're seeing now is, as you mentioned, Tom, the add-ons are being a big part of the M&A activity isn't really a surprise, because if you think about the private equity in particular, or strategic owners of businesses, for about 3 months, certainly the feedback we were getting, and in our portfolio too, everyone was just battening down the hatches, making sure that their portfolio was intact, sort of looking at damage potentially, but also opportunities. And that's where you see, I think, a lot of that add-on volume that happened really in Q3. What we're seeing now is a fairly dramatic pickup in volume. And as Alice said, I think rightly so, some of it's pent-up demand. I think some of it is your natural sort of year-end push, and then maybe even more so with the tax overhang. I think there's a widely held belief that taxes are going up, capital gains in particular, maybe regardless of who wins the election, but certainly if there's some sort of blue wave. And so if you are a seller and you have a process or you are in process or have been planning to be in a process, there's a new sort of impetus to get it done by year end. So we're seeing a real pickup on a daily basis in new deal volume, which we expect to continue really into 21. I think people will take a step back for maybe a couple of months after the election and really sort of assess what's going on. And then we expect it to continue.
And Sydney, what are your thoughts? I mean, you've had a lot of conversations this year with business owners.
Yeah, no, unfortunately, from my vantage as a fundless sponsor, I would certainly echo, everyone's comments, and it's been really, perhaps it shouldn't be surprising, but even looking at, pretty, businesses well below 1 million in sort of annual, earnings or EBITDA, some very competitive processes with larger middle market funds, get involved on those sides. So whether perhaps it's for add-ons or other reasons, but, looking at talking to friends and colleagues higher up the food chain than me, they're looking at the same stuff that typically they, historically they wouldn't necessarily be interested in. And so I'd certainly probably a good time to be a seller if they, have those higher quality assets. I'd say the other thing too is really have seen, at least at the lower end, where we tend to look, a real bifurcation of businesses. And so there's unfortunately a lot of the businesses that, aren't going to be able to be financed through traditional SBA type loans or even commercial lenders. And so I'm not, not really sure what's going to happen with some of those more distressed or COVID impacted businesses, and then obviously the higher quality ones, the ones that have either sort of survived the knife fight and sort of stayed in line with 2019 or even grown this year, are really command a higher multiple. So not seeing a lot sort of in the middle ground right now, but could be some bias on my part there.
And I guess staying on kind of the macro theme of kind of valuation of deal volume, what industries have y'all seen investors or private equity funds or strategics avoid? Which ones have been the hot ones? Any generalizations you guys can make other than kind of the high quality assets?
Yeah, from our standpoint, some of it's pretty obvious. Clearly, anything retail oriented has been challenging. I think folks still think that there's a ways to go to figure out who's going to survive and who's going to thrive on that side of things. And as really Sydney and Alice alluded to, the high growth software technology plays, you've seen it in the public markets as well as in the private markets. Where valuations, I think a lot of it is folks are looking at what we now have another data point. We've had data points 10 years ago with the downturn. We've had them in various stages, and now we have a pandemic data point. So people are looking at businesses and which ones are more resilient than others in sort of almost a draconian scenario where you shut down the economy. So recurring revenue type businesses are certainly getting a lot of love on the valuation side. The ones who, and maybe there's a bifurcation there too. We've seen some businesses that I would argue have just shot to the moon, and it's 100% because of COVID, not because of their business model being better than another business model. So those, I think people are taking a little bit, they're interesting. We saw a business that was 8 million of EBITDA, run rate of 8 million of EBITDA in February, and they're in the filtration business. And so it just by chance, their filters work very well with COVID. And now their run rate is about 300 million. So, I don't know that anybody's going to pay them on that run rate. So that's going to be an interesting sort of way things play out. How much of a premium do you pay for something that hopefully I think we can all agree, we hope that COVID isn't as much in our dialect in the next, 12 months or 24 months from now. So, but the recurring revenue businesses that subscription based, that kind of thing, are definitely where there's a lot of activity and frothy, higher valuations, I shouldn't say frothiness. Retail and energy and that sort of thing are more challenging.
I agree with all of Doug's comments. I think where we spend our time, I'd say the one area we kind of don't spend much time is consumer retail. So we're focused more on the B2B businesses across healthcare services, technology and telecom, and then business and industrial services. And I would say it's been uneven and hard to forecast. So number one is, as Doug pointed out, for some businesses, there's been a COVID bump. And so figuring out, how much of maybe new business this year is episodic and tied to COVID this year versus how much might stick and become more recurring or reoccurring revenue into the future is incumbent on us to figure out as part of our diligence. But the other thing, just on sort of unevenness and hard to forecast, we've seen a lot of businesses where you'd think they'd be getting crushed, they're not, or maybe a unit within them you'd think would be doing really well and it's not. It's just hard to predict, uneven, which has also been kind of interesting to navigate and hard to make kind of a blanket statement about this area is hot, this area is not. That's just been kind of our observation.
All right, so we've talked about valuation, we've talked about kind of what's hot and what's not, we've talked about deal volume. What lawyers like talking about is kind of deal terms, and how has what has gone on this year impacted deal terms, from rep and warranty insurance, from indemnification, from definitions, financial definitions such as indebtedness, and kind of the elephant in the room, the PPP loan that most companies, most of our clients got. How has that impacted kind of deals and deal terms? And we'll start with Doug.
Yeah, I think it's still a deal by deal sort of approach. Certainly that's the way we've approached it. I think with regard to the PPP loans, our personal experiences is in an M&A transaction. It's fairly simple. If there's some concern, no one really knows what the forgiveness process looks like quite yet. So I think the easiest thing to do is a seller liability, or it stays with the seller, however you want to think about it. But or there's some sort of carve out. We've escrowed those dollars. We've done a couple other things just to until it's forgiven, and then you sort of have a settle up process where the seller would keep those dollars, or again, depends on whether the dollars have been used or whether they're sitting there. There's a lot of variables there, but not a lot of difference in terms. We have probably seen a little bit more aggressive earnouts, holdbacks, those kind of things. Related to what I think Alice said earlier is you want, if you're on the buy side, you want to sort of box in as much as you can the how much of this is one-time stuff, how much is all the unknowns you try to sort of box in any time, but especially right now. So I don't think we haven't seen anything that jumps out that's just totally different than it was 6 months ago as far as deal terms. We haven't seen a big pickup in rep and warranty insurance, that kind of thing. That was already a trend probably for the last 3 years anyway.
Okay.
I'd agree with Doug. I'd agree with Doug. We haven't seen any COVID related reps. And on the topic of PPP loans, I'd echo what he said around, there were some complexities around business that took PPP financing and their ability to do a change of control transaction. But the SBA came out with some guidance in recent weeks that has kind of cleared that up, and it's, I'd say, not really an issue. I know you guys also had one of these forums where you talked about that topic, which was really helpful. But I'd say, for us, the way we've treated PPP loans is that is a liability that would stay with the seller. So if you took a PPP loan and you intend to apply for forgiveness, you'd work with your lender to apply for that forgiveness. If it's not forgiven, then that liability would reside with the seller, and then there'd be some type of escrow to reflect that. So that's what we've seen. And on the topic of structure, Doug made a very good point, which is that, while we haven't seen really an impact to valuations, so we haven't seen valuation multiples come down, we have seen maybe some impact to structure, where perhaps to account for some of the uncertainty around future performance, you move some of the purchase price of a business into more of an earnout or seller's financing or some type of true up that could take place at some point in the future. Recognizing that, if you as a business, you've won new business, well, we plan to pay for that. But let's just make sure you have won it and it's going to come to fruition as everyone expects. So we have maybe seen some increase in like earnout type structures, that sort of thing, like a true up in the future on the structure side. The other thing that we've seen too, this is sort of less on the terms, but maybe more on the diligence, is we have seen more creative adjustments to EBITDA. And again, to Doug's point, that existed, pre-COVID. So it's not just COVID-related EBITDA adjustments, but it's adjustments of all kind that, it's not a deal killer. It just makes us as the buyer, it makes it a little harder to figure out what's real earnings and what's not. So for example, if you have an airplane that's running through your P&L and that's not going to be a go forward cost to the business, that's an obvious EBITDA add back. But if you have, want a new customer and want to, get credit on a run rate basis going forward for that new business, or if you've negotiated terms with a supplier that means, a 15% reduction in cost and you want to get credit for that, some of those add backs can just make things a little bit trickier. So again, not, a showstopper, but just something that has taken a little more time to diligence.
And from a lender perspective, how have lenders handled COVID-related adjustments that, maybe a seller says that they had a bad 2 months, March, April, May. How have the funds and then their financing sources handled that? And I'll start with Doug again, I guess, since you're on the credit side more.
Yeah, I don't think it's, as Alice alluded to, we've seen some pretty aggressive adjustments or proposed adjustments for years now, really. So we haven't seen, anything drastically different. Obviously there are some things specific to COVID that a would-be seller would want you to recognize, either not seeing them or give them credit for. And, maybe there's a little bit more discussion around those kind of things, but as Alice said, and we alluded to earlier, I think you're seeing that there's always a creative way to, if it's a good business and all the parties are interested in transacting, you usually can find a solution. Either you sort of defer that, you say, look, we agree, we think that is a one-time thing, either good or bad, but let's just make sure it is. And so you maybe escrow more, or you attach an earn-out or something along those lines. So I don't think it's hard to, for those of us who've been doing this a while, it's been, I would say the level of sort of add backs have been very aggressive on the high end of aggressive scale for the last 4 or 5 years. So it doesn't feel all that different to me.
Okay. So last question before we open it up to Q&A. Sydney, most of the attendees are business owners. And if you're a business owner and you're thinking about selling now or in the next year or two, what are some things to think about for that business owner?
Yeah, I think it's somewhat obvious and a bit of a general statement, but obviously timing is critical on getting started earlier, whether it's engaging, advisors or bankers or, firms such as, Manning Fulton. I would say have those conversations early. Tom, we ran into this the last one, where, there were certainly, extensions involved to the LOI and having things that perhaps we could have, foreseen a little bit earlier that added complexity to the deals. But I would say, having those conversations with intermediaries or other advisors earlier rather than later can certainly make the process, potentially a lot smoother, especially to the extent on the credit side where there are going to be consents required, whether it's SBA or other lenders. Again, we, looking back on a recent deal, that was certainly, could have been an issue, and making sure you're engaged with your lender or the buyer's lender, as soon as possible. Just knowing that, there is going to be some added time or due diligence required, whether there is a impact from COVID or not. So for me, it's just really timing and engaging subject matter experts or deal folks as soon as possible, just to make that a much smoother transition.
And Alice, what would you say?
I think Sydney answered that great. I would say, as a business owner thinking about selling your business or bringing on a capital partner, each business owner's objectives are going to be different, and how they prioritize those objectives and what they want to achieve with the transaction, their priorities are going to be different. And then to add to that, you're going to have different options for achieving those objectives. And you might not know what those options are. You're an expert at running your business. That is, more than a full-time job, I'm sure. So talking to someone whose job it is to know what your options are, I would strongly encourage a business owner to do that. And I'm not saying go out and hire an investment bank. There are folks that can be a sounding board and give you advice just in terms of how you might achieve your objectives rather. There may be options out there available to you that didn't exist 5 years ago or 3 years ago. So talking to someone whose job it is to know what those options are to get you everything that you want. And if you don't know who to turn to, it would be anyone on this panel and Tom, and we could point you in the right direction. Brown Brothers, for example, not to turn this into a BBH commercial, but we're not an investment bank. So even if you do decide to sell your business, we're not going to get paid, but we do have folks. We've got a gentleman in Charlotte whose job it is to be a sounding board and try and be helpful to business owners, free of charge. So I'd say, talk to someone whose expert it is who is an expert in knowing kind of how to get you what you want would be my advice.
Yeah, Doug, anything to add?
Yeah. And Tom, I'd just add from a perspective of a former business owner and operator, I think there's first I always encourage business owners who are thinking about selling is really to think hard about why you're selling. And sometimes we run into this all the time. Sometimes people really don't either want to sell or need to sell or should be selling. Other times I would flip that, and they probably should be doing all the alternative. But oftentimes it's as simple as, well, I heard my buddy got this price, so that's why I'm selling. That's not a good reason to sell. So you got to do your own self-assessment, and then as Alice said, you really, I think there's probably two more steps. One is getting some feedback, some advice, and there's lots of good resources out there that don't cost anything initially. But be ready at any time. This is the other thing I've certainly learned is when we go into a process, if the records are a mess, if the financials are a mess and haven't been either reviewed or audited, it just hurts the seller. So be prepared. Just even if you're not thinking you're going to sell for 5 years, run the business as if somebody might call tomorrow and you have information you could send them after a 10-minute phone call that would give them a good sense of what the business looks like. And that's really important because we get these choppy sort of cycles, and people tend to think more or less about selling or buying and that kind of thing during these crazy times. And if you're ready, you're going to just benefit from that. And then lastly, again, to the earlier comments really from everybody is once you decide to do that, do get representation that has done it before. And I think that's really important. It sounds silly, but we run into a lot of people who hire their next door neighbor. We did a deal earlier this year, and the attorney on the other side had never done a deal before. And I think she was actually a divorce attorney. I'm not quite sure, but it really created, it was a disservice to the seller. In fact, it definitely impacted the value that he got. So it's just much better to have people who've been there, done that, much more. It ends up costing you less in the long run, I can assure you.
That makes perfect sense, and appreciate your all's answers to this and earlier questions. I guess if we've got time for Q&A, if anyone out there has questions, I think it's the chat room where you can type your questions. I know we've had some questions in previous webinars, so let's see if anything pops up here. I'll give that about 5 or 10 seconds, and if not, don't see any questions. We've got a quiet group out there. Well, the three of y'all, really appreciate your all's time this morning. This has been informative. I know our clients that have logged on really appreciate the advice and counsel you guys have provided, and hope Q4 is as good as Q3, and hope next year is as good for you guys as well. Thank you, guys.
Thank you, Tom.
Thanks, Tom.
Thanks,
All right,
Tom.
everyone have a good day.
Thanks very much.
All right.